Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
On today's episode, we have Apurva Mehta. He's the co-founder and managing partner at Summit Peak Investments, a firm backing top pre-seed and seed GPs, and also has a direct Series B plus co-investment strategy. He has an illustrious career as an allocator and investor, with stints at Cook Children's Hospital and also the Juilliard School's endowment. And today he's going to share with us his journey from managing institutional portfolios to building a fund of funds, what it means to be a relationship first LP, and as we were talking about in the prep of this conversation, some of his worries about the current trends that are happening in this market. So with that, we welcome Apurva.
Thank you, Ernest, Alexa. Appreciate you having me.
Of course.
Glad to have you on. I mentioned a little bit in the bio on just like your different stints and how it's really shaped your experience, but I want to kind of just dig a little deeper on like how you became an allocator, and what led you to this point today.
I guess I kind of fell into it. I mean, I've been interested in investing my entire life. So, I mean, you know, from the age of 14, I think if you were to ask my mom, she'd say I just was infatuated with making money. And so, and so she said, when I came into this allocator world, she said I finally had found my home of like, you know, what I was meant to do for a living. And but you know, it started in high school with a stock market competition, and I just kind of love the competitive aspect of, you know, building a portfolio and trying to win, you know, who's gonna make the most money at the end of, you know, however many weeks. To then working at Smith Barney and, you know, sort of being an allocator and, you know, doing sort of manager selection and search. And then after that, you know, a stint at Lehman Brothers for 4 years, you know, learned a ton. I mean, you know, I think as we were sort of joking earlier about the digital age, you know, I learned a ton of things that'll become useless tools today, like Excel and PowerPoint. But, you know, learned about how being detail oriented is important. And then post Lehman, you know, fell into this role at Juilliard. I mean, it was really, it was 2008. There was a ton of fallout from kind of the GFC, fall of '08. And, you know, happened to interview for this role at the Juilliard School. And they had Cambridge Associates as a consultant, and they were building out their investment office. And it was awesome. I mean, it was awesome to kind of leave Wall Street, quote unquote, but then be in this allocator community, and that's kind of where I fell in love with the space. And so, you know, from then, you know, that's where I met Patrick. He was at the University of Arizona, and you know, I've always been you know, network first investor, and so built a great network in New York, and really across the U.S. of different allocators, and that's, you know, from Juilliard, it led me to Fort Worth, Texas, you know, over 14 years ago.
You described this community and this sort of network first allocator. What does that universe look like for our GPs listening and for our sort of junior allocators who are looking to kind of follow in your footsteps?
So, I mean, it started at Juilliard. You know, we're less so in this age of resource constrained investors. And I say that there are some endowments and foundations that are, you know, $5 billion and only 3 people on the staff. But generally, I mean, almost 20 years ago, there was 1 or 2 people managing these massive pools, and they were resource constrained. And so, you know, I built this community in New York of, hey, let's all share ideas. And it was, you know, called an institutional idea dinner. And I hosted them monthly, starting in, you know, 2008. And it started as 10 to 15 allocators getting together and just like, this is what I'm working on in hedge fund land, and this is what I'm looking at. And it grew to, probably into 2017 or 2018 to be 50 different allocators. So I would say the endowment foundation world is less resource constrained than it was, almost 20 years ago. But it was just a great way to build community. About a decade ago or more than that, we started investing in venture, and we wanted to do the same thing. We're at Summit Peak, and starting in 2012 when we started investing in venture, we're backing solo GPs, which means you are inevitably resource constrained. You are managing a portfolio of 30 to 40 companies, and obviously you're outsourcing everything else, but you're still you're bandwidth constrained. And so we just we thought, like, let's replicate what we were doing in the allocator world to the GP network, GP community. And so it started, probably in 2014, these GP community dinners. And it was just a way for everyone to get together. Back then it was probably quarterly. Now it's roughly monthly. Last week we did one in LA. Next week we're doing one in San Francisco. And it's just a way to bring the community together. And by that, it's everyone comes from different networks or ecosystems. They have different strategies and portfolio constructions. But, it brings, we invest in these GPs for different reasons, and it brings this community together. We invite founders to it. We invite investors of ours. We invite prospective investors, anybody in the community honestly that we think can benefit. It could be potential customers of a company, if we have relationship. So, for us, it's a great way to meet and connect with our existing GPs. We also, besides, we meet a GP, and I think we know from a first meeting whether somebody fits into our portfolio, but we want to get to know them over the next 3 to 6 months before we sign that commitment. And it's, if we only invest in one fund, it's a 10 to 15 year marriage. And so, we want to see how they interact with the community. Like, do they come in and, are they the bull in the china shop? Are they, how do they interact with the rest of our GPs? And it's just a way to get to know somebody outside of, a Zoom or office setting. And it's really the best way.
What was the impetus or the sort of light bulb moment for creating Summit Peak? What's the insight there?
I think, Patrick and I always wanted to do something entrepreneurial. There isn't a day that goes by. I mean, so we started working together in 2011. In 2013, we started having these entrepreneurial light bulbs go off of, like, let's do something entrepreneurial, which we were already, he was the first CIO, had a blank sheet of paper to go build this investment office, then brought me in, and we were already doing something entrepreneurial. Then we said, let's build out a venture portfolio at a time when people were running the other way. And so in 2013, we were approached by a big institution that liked how we were investing in hedge funds. And they were like, hey, why don't you build out a hedge fund of funds portfolio for us? So we said, maybe this is an idea. Maybe we can, turn this children's hospital into an investment management company. And so we kind of for 5 years played with this idea of, like, do we build an outsourced CIO? Do we, spin this out into an investment management company? And inevitably, the mission of the children's hospital is to, save children's lives and treat children. And so it just, it didn't make sense to do it within the children's hospital. And, of all the asset classes where we spend time, that entrepreneurial spirit that we have, it just gives you energy. I was in San Francisco last week. I'm there roughly every other week. And so I was in San Francisco last week, and I told the GP, like, it's because I had just watched Superman the weekend before with my daughter. But, like, I told the GP that, like, spending time with GPs and our founders is like, the yellow sun to me. It gives me energy. Yeah. And, like, I feel so alive hearing about the innovation and what people are building. And so doing that a decade ago, of all the asset classes that we could go start a business, it's the one place that's really difficult to navigate. And, access really matters. And so, of all the dirty words that we could go build a firm around, fund of funds was the worst.
So throughout the story, one thing that really interested me was the intention of building those networks. Like that's really fascinating. And in a world, you talked about kind of like the resources constraint was a reason. I would also assume, especially as you were, 10 years ago looking to get into venture, especially kind of like micro VCs and whatnot, there was information constraint. Fast forward is not much information constraint, right? And you at your fingertips, you can get to, with the network you guys have built, you can get to people. Talk to me a little bit of why you all still feel the need to have these gatherings. I understand being the central node, but like, what does it do for you all as well in strengthening your point of view as well as like how you execute on strategy?
So, I mean, being that central node and being top of mind, it really allows, when GPs, for us, that GP relationship isn't just commit dollars, see you at the next fundraise. We don't necessarily want to read the quarterly letter and get an update in that form or go to the annual meeting. I went to an annual meeting last week and I was like, this is all new. None of this is new news to me because we like just having that regular interaction and flow with our GPs.
Yeah.
And so it creates just a natural connection. It's the same way that a GP is with founders. They've got 30 portfolio companies. They have these casual coffees. They host events where they bring founders together. Everyone talks about the problems they're trying to solve, as different founders. That's kind of the same as what we're doing. We've got a portfolio of 20 to 30 GPs across 4 funds now, and everyone's talking about the problems that they're trying to solve. And for us, that allows GPs to think of us of like, when someone new is coming out with a new fund, a new network or ecosystem, it's important to be the first call. I mean, that information advantage, we want to be there first. We want to help shape a new firm's future. When it becomes oversubscribed and there's like this, mad dash to like a final close or, we have no edge at that point of, or value that we can provide to that GP. And so we like being at the start of a firm's journey. Our portfolio, 50 to 60% of what we do, we call core managers. Mm-hmm. And a core manager is now proven. They're on funds 3, 4, 5. They don't necessarily need our advice anymore, but, there's a repeatability to what they do and the results that they're going to do, and the founders that they attract from how they deploy capital. And that's a good thing. There's more persistence in results and returns in venture than other asset classes. So you need that. Mm-hmm. But 15% of what we do is finding new GPs. We're continually looking for, the next generation of firms out there. And we like being there day zero, and really helping them, think about that story, think about, are they articulating well what their right to win is and what their portfolio strategy is, and where they should think about taking capital from, meaning should they take capital from family offices or endowments, or how concentrated should somebody be? Should they give up a GP stake? We don't take GP stakes. We think just put some elbow grease into it. If this fund, if you're targeting 20 and it only turns out to be 14, it's okay. Just kind of grind it out, and then the next one, adjust accordingly. So we try to give the same way that our GPs are providing some value to founders, and that's how they win deals. In a capital, a really capital abundant framework of whether it's allocators to VCs or, GPs to founders, there's capital available. There's no scarcity. Yeah. There's a scarcity of liquidity, but there's no scarcity.
that there is.
there's no scarcity of capital. And so founders want to take money from GPs that truly see the value that they're going to bring from getting them from pre-seed seed to Series A. And and I think it's the same in the GP world.
That's critical. That means you're developing real relationships. And in a world where everyone's email address is going to become their Yahoo email address, it's important if you can be someone who people feel comfortable enough to call. And the other thing that's going on is, you spoke about that 15% is for new managers. That world has changed since you guys were first starting, and there's just a ton more, right? Like you have these conferences like Raise and others, and there's going to be hundreds.
Raise is next week.
Yeah.
You've got Bridge.
Exactly. So there's a lot to select from. Like how do you all think about not only filtering for what fits you, but like also having that little piece that I know works in your brain of like, are we iterating to what's going to be successful for the next 15 years, not what was successful for us the last?
Yeah. I mean, the evolution is crazy. You're right. I mean, it's way easier, way cheaper to launch. It's kind of like company evolution. 20 years ago, it was way more expensive to launch a business than it is today. 25 years ago, sorry. It is way more expensive to launch a company than it is today. And now I throw in AI and everything's just cheaper to start a company. The same goes for fund management. Everything from administration to audit, everything, I don't want to say it's gotten commoditized, but it's gotten cheaper, which means that anyone can do it. Anyone with deal flow can theoretically do it as cheap as on AngelList as possible. So that's a change over the last 12 to 15 years in investing in the space, which means it's gotten more crowded. When we started in this space, it was a little bit easier to identify networks and ecosystems, meaning there weren't so many of them. There was Y Combinator, then there was the universities, and then there was Facebook and like corporates and people that had deal flow, or like the PayPal mafia.
Yeah.
There was less mafias out there than there are today. And that's because there's been so much company value creation, whether it's the Uber mafia or the Airbnb mafia, or like all of this value creation that's happened in tech has created more and more networks, or nodes, if you will.
Yeah.
And so that means there's more and more firms popping up. So it is, there's a lot more noise in the market, today than there was. And in terms of, figuring out how to identify, who really is good, what networks and ecosystems are truly relevant. I guess that's the first piece. Before, it was very easy to identify the relevant networks and ecosystems. And then, you had to, we leveraged our network to figure out who was good or not. Now it's first, is this a relevant network or ecosystem? We still, what's changed over the last 15 years is we just have a deeper network, so we can, quickly triangulate on, the relevance, not only of the network ecosystem, but, every GP is going to say, here's my value add. Here's why I win deals. And, our ability today to triangulate on that is, I would say at a lightning speed. We can, after one meeting, make 5 phone calls and figure that out, is what they say really true? Are they really, and so the network effect compounds over time. We're better today. And I think, don't tell our fund 1 to 3 investors, but like our fund 4 will be our best portfolio, because we're constantly iterating, like for the market that we're entering and the market over the next 15 years, like this is what makes sense from a portfolio construction perspective. And we have to kind of be at the forefront of it. Like our portfolios aren't static in time. There is attrition from one fund to a next because we're making sure we're iterating on what's appropriate for the market. And so, but it's, for us, network drive sourcing, that's what's evolved in a massive way, over the last 15 years. I've been involved in Bridge and been on the board of Bridge, and I've been in, I'm on the selection committee for Raise. There are great managers that come through. It's a lot to digest. On the selection committee, I mean, I reviewed like 40 decks, and
Yeah.
it's it's a lot. So it's one way to start. If I were giving advice to somebody that was starting out, I'd say find somebody that understands how to not saying use a fund of funds, but just find somebody within the networks of Silicon Valley or US venture that understands how to navigate and leverage that. I mean, that
Yeah.
is because it is a daunting task to go to these things, but get pitched, and everything sounds amazing.
Yes.
Everyone's got logos of, here's my prior track record, here's the value add, here's why we win. It's with so many resources like Bridge and Raise, which are really helpful to GPs, the pitch, it gets better. It's like Y Combinator. The pitch all sound the same now because, it's you're getting so much guidance, which is a good thing. But as an LP, it's hard to then navigate and differentiate that.
Yeah. Very wise, because I think with venture, especially if you've been successful in other asset classes, you assume, oh, I should just be able to easily get into venture. And there's not a one-to-one, all these allocators I've spoken to, there's not a one-to-one dollar at a time that you're going to spend on, that you might spend a lot more time and then allocate a little bit of dollars.
Yeah, that's probably the biggest learning, I guess. I mean, it's the least quantitative asset class. I mean, you could look at private credit, you could look at real estate, you can look at hedge funds. It's the least quantitative asset class, unless a firm is 10 or 15 years old.
Yeah.
Even then, you're still thinking about the next 15 years and their ability to win deals. And is this portfolio construction appropriate for the strategy that they're going to execute on? So it is the hardest asset class because there is a piece of you that really it's a gut intuition of, do they have what it takes? A portfolio of a manager of a hedge fund, there's a lot of quantitative analysis. And so and to your point, you spend all this time and it's at least dollars deployed in a portfolio.
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have our stellar partner and industry expert, Shane Goudey. He's the leader of Sidley's venture funds practice. And if you get value from this podcast, we have Shane and the Sidley team to thank for it. They make these recordings possible. We are looking forward to hearing from you, Shane. You lead the venture funds practice at Sidley. Could you just describe for us the team and the work you do?
Yeah. So my focus, my day-to-day focus is working with venture capitalists of all sizes, shapes, creeds, and colors, the multi-billion-dollar per fund asset managers in the business, running all the way down to brand new emerging managers forming a $5 to $10 million fund. It really, truly is an entire ecosystem practice. Purposefully agnostic because the fun is in who you get to represent on a day-to-day basis. So we really do it all. And, so I've started at Sidley about a year and a half ago. I was at another firm for a quarter century. So I've been swimming in the venture fund waters for a very long time. And they are wonderful waters to swim in. I find myself just energized and refreshed and loving what I do. Here at Sidley, I am the head of the venture funds practice. Our funds practice is, quite sizable. It's about 140 lawyers and representing all different sectors of the investment management space. I was brought over to Sidley to really bolster and build the venture fund side of the practice. We have a nice, robust emerging companies practice, but in order for us to be able to represent the full ecosystem, I was brought on to kind of be the last piece of the puzzle to help us really maximize our opportunities. So the team is now about 25 lawyers. It was, me about a year and a half ago. And so we've aggressively built and certainly used a lot of internal associates to build our team. And now we have a really great practice of people who, through lateral partner and associate hiring from key other firms with deep experience and really the right frame of mind for how to represent VCs in doing this work, because I think there are a lot of people who can do the work of representing funds, but actually it's not just doing the kind of fund formation. You have to understand the market and the mentality and what it really means to be a VC and how that reflects itself in a fund formation project. So, we're really building kind of a practice that is built to be the concierge service for venture firms of, any size, any shape, and we're kind of built for speed and built for quality, and we're really excited about what we're doing, and the firm's been incredibly supportive, and we just are we're enthusiastic to be a real great part of the venture ecosystem. So
It seems like as you've been building the team, we've also been seeing momentum build on the fund formation side. Can you share just anecdotally what you're feeling here in the end of 2025?
Yeah, no. It's absolutely nice dovetail to have to build a practice when things are getting busy. From a fund formation standpoint, it is as busy as it has been in the last 3 years. This is naturally a time of year when a lot of funds are doing their fundraising plans over the final quarter of the year to be able to kind of have a first closing around January, late January, early February, to take advantage of the fresh buckets of allocation for very large venture investors, but also people who, whether it's family offices or high net worth, fresh buckets of capital in their own kind of personal stakes to be able to invest. So just the natural time of year is great, but the market is really good now, right? We've got a lot of M&A and IPO activity. I've heard of a couple SPACs back again. The upside of the market is very busy providing liquidity for a lot of venture firms. And that obviously is the fuel in the tank for any of these firms to be able to fundraise. You got to produce returns. And from a time over the last 2 to 3 years where there hasn't been much of that, or you've had to be very, very creative about how to create secondary opportunities, this tends to be kind of relying on some of the more natural channels of M&A, IPO activity to have hope, at least, that things are starting to turn around. And if I look at the number of funds that are out there now raising, these are more, certainly not 2021 days, but big markets which have sort of been the hallmark of the last 3 decades. These are kind of a little bit of the evidence of what's gone on in some of those markets. Mm-hmm. So we're pretty excited in our sector of the world.
And now back to our LP interview.
Is there, you look at a lot of different fund manager decks and, meet a lot of fund managers. Is there a certain strategy or profile that you're surprised you're not seeing or that you're looking for?
I think going back to what I've said, like the market has evolved where I guess what I'm surprised to see today is there are managers coming out of places, and we like seeing managers crawl, walk, run, meaning have a set strategy around $25 million fund one, X ownership, grow to $50 million fund two or $75 million fund two or 80, whatever it is, and see a progression of ownership, board seats, things like that. I would say we're seeing more and more managers come out and like they're going straight for the
run.
For the run. And I mean, some can do it because of, the background that they have or where they came out of, that brand, sort of that brand backing that they have. So I guess I'm seeing more of that. There is a lot of attrition coming from, brand name firms, whether it's Sequoia or Andreessen. It doesn't speak. I don't know the reasons why, but there's just a lot of that, and so we tend to favor the founder operator turned VC, that has a track record investing, but they're a founder operator, and that's the kind of firm that we tend to favor. And all of last year, I saw so many spinouts from brand name firms. I think the market is favoring brand recognition, and we've tended to favor non-brands in the past. Because we favor kind of that founder operator first mentality. So it's not to say that we won't invest in people that have come and worked at a brand, but so I guess in terms of what we're not seeing is because the market might be a little bit frothy, and because people are coming out of brands, you're seeing more of that, going straight to the run first. And so I guess I wish I'd see more of that crawl, walk, run, sort of thoughtfully and patiently, measuring how you build your firm.
You mentioned a little bit about some things you're worried about that you're seeing, right? It's just like you're keeping note of since us coming out of the last kind of like run up. Could you just speak to the audience on that and how that's shaping your perspective right now?
Yeah, it's as we're putting together our Fund 4 portfolio right now, and all of sort of re-underwriting of existing managers or looking at new managers, in 2021, the market got crazy. I mean,
Yeah.
it was the speed at which people were raising capital, deploying capital, got crazy, and fund sizes got crazy. It meant that there was a lot of style strategy drift. We tend to favor pre-seed, seed, up to early stage, and people became multi-stage and really veered off the path. And for the most part, that just really means like valuation discipline. And so that, I guess, is probably my biggest fear today. Whether it's AI, founders coming out of places. I mean, as I mentioned last week, we were in San Francisco and met with a GP. She's raised her second fund, was 2 or 3x oversubscribed, and she was just talking about what she's seeing in the market. And she tends to, she wants high ownership, and she was just describing like some of the valuations are insane. I mean, she's slowed down her investment pace because of that, sort of cautiousness around valuations. But given that valuation piece, it means managers are upping their fund size to back into ownership. And so it's like this, I don't know, it's this twisted circle, that one is driving the other. And, I don't know how, I guess I know how the story ends. I mean, it just means, you're going to have a bunch of lopsided funds at some point, or just like a poor returning vintage, if there's not valuation discipline. So I feel good about, managers that we talk to when I, that meeting last week where they say, hey, we're not doing $80 million seed rounds. It's just,
Jesus.
I mean, and there's some seed rounds happening at 100. I mean, the entire genesis of what we believed 13 years ago was that you can invest in these pre-seed seed firms and not everything needs to be $1 billion outcome. And we're seeing it, in this liquidity constrained environment that we're in today. We had a GP about 3 weeks ago who had invested 750,000 of an $85 million fund. They sold that position into a growth round, and they returned 50% of our commitment back to us.
Wow.
And so that's an example of why the math works when fund sizes are small. And so if fund sizes are growing to be enormous, valuations are ballooning, everything does need to be, a billion or multi-billion dollar outcome to make the return the fund math work.
So with all of that in the current market, how has that impacted your hybrid approach of the growth deals that you all participate in?
I mean, from the beginning, we've tried to stay true to Series B. I mean, so we look at Series B. Generally that's going to be a company. We'll do a little bit of pre-Series B investing and a little bit of post-Series B. And as you know, like letters are, there's a fallacy around letters. So it's really around revenue and growth metrics and things like that. But the Series B sweet spot is, company is let's just say in the $3 to $5 million revenue range, growing at 3 times year over year, so approaching 10, and then gonna, if it's not in AI, I mean, if it's in AI, it should be 10xing from there. But if it's not in
Yeah.
AI, I think somebody said it, the triple, triple, double, double, double is, which is like growing revenue, triple, triple, double, double, double. I think that playbook is out now. And now it's like, 1x, 10x, 100x. And
Grand slam, hat trick, some.
but so we like that sweet spot. There is less risk of a company going out of business. There's always risk of a company going out of business at any stage. But there's less, call it risk of a company going out of business. The valuation range for us at that stage, will be, 75, 80 million, 100 million on the low end to 400, 500 on the high end. And, if it's on the high end, we're underwriting, hey, do we think that the market opportunity supports a 10x from here? And so for us, that hasn't changed. I mean, market pricing dictates, like, are we overpaying for growth? So in 2020 or 2021, we might have been in a Series B at the top end of that 450 million dollar range for a Series B relative to the revenue that they had, and they've now grown into it. But so depending on market, it just that dictates a little bit of kind of the current revenue multiple we'll pay and forward looking. But as we try to be disciplined, like, we're really not trying to overpay. We've seen Series A's and even seeds, which are 1,000x forward looking revenue, and we're just, while I'm sure, if we had a seed fund, I'm sure it would make sense, but it's just, there's going to be a lot of zeros, as there should be. I mean, venture is meant to have mortality, but at the Series B, it's supposed to be less. That mortality is supposed to go down as you move down the stages. And so, for us, really, our co-investment strategy hasn't changed. We like to be, going back to being in front of our GPs. We'd like to be a really good partner there. I mean, a lot of investors talk about wanting to co-invest, whether it's a family
Yes.
office
Yep.
to an endowment or foundation. And, for us, we're continually cultivating our portfolio for deal flow because we're talking to our GPs constantly. It is, hey, this company's doing really well and they're going to be going out for their Series B in Q1. And that gives us the ability to start doing work now or 6 months ago and have a year lead time. And having that year lead time means that we can go to a GP and say, hey, we'll take 2 to 3 million out of our fund. And then our investors also like investing alongside of us. We're going to do 5 million out of an SPV. So it arms a GP with, like, hey, we know Summit Peak is good for $3 to $8 million, and so we can go and ask for super pro rata. So that's how we try to be a good partner to our GPs, transparent and then fast in our process.
That was going to be my next question. Is so many LPs say they want to do co-investing, but what they end up doing is something that is a lot more passive and that doesn't have like some level of rigor to it as well, right? So, they're waiting for when GPs, they're not being proactive like yourself and actually having those conversations, making those notes, and then starting with on those relationships with those founders. They're just waiting for the things to happen, and they're slow. One thing I don't think I've ever asked anybody that I'll ask you is, obviously you're very networked, and you guys are opposite of passive, with being intentional and meeting new GPs. When you finally met a GP that you've done your diligence homework and you want to do be involved in allocation, and they're oversubscribed, what's your approach to winning that allocation? Just for, in the context is like, we have a lot of allocators who listen. And so when they actually have done the work and feel that they feel fit.
Yeah, I mean, there's
how
been
do
a
you win?
couple. I would say in the last year or two, there's been a couple of cases where that's happened, where regardless of how we sourced it, meaning we sourced it through our network, which meant that we already got to them because of our network. But there was a case earlier this year where, GP spun out of a different firm. We were the first meeting, even before there was a deck. But it quickly became this, like, a lot of people interested. So we leveraged our network. I mean, we said, call up any of these GPs that these are people that we've backed and you know them well. Call them up and ask them what they think of us as a partner. It's kind of no different than like a GP with a founder saying, a founder seeing like, do I want this person on my cap table? Are they going to be a value add partner? And so that's how we've won. In the sense of either they're going to make room for us, or that's how we've won, the allocation we want, because these GPs will call up other GPs and like, how is Summit Peak as a partner? I mean, they tell a good story, but are they really like, once the docs are signed, sealed, and delivered, do they become like the opposite of what they're selling? Because we've just met, and so it's impossible to get to know us in that short of a time frame. And so that's, I mean, this past year, it's happened twice in sort of oversubscribed scenarios. And they were like, no, we've heard great things about you from our GP network. And, we want to build a long-term relationship with you. And so that's kind of, that I would say that's how we win.
Where do you think the next 10 years will go? In particular, like what trends do you think where allocators place their bets? Where they're currently placing their bets, do you think that will change? As you mentioned, kind of like the brand. Will you see more fragmentation? What do you think the market will go?
I think you're seeing it in allocators today. I mean, it's been over the last year. I think you're going to continue to see it. I mean, you're going to see more big firms turn into SEC registered firms. I don't welcome SEC registration upon anybody.
It's a lot.
But they have enough people to do it. But I think you're going to see more bigger, firms on the brand side turn into SEC registered firms. You're going to see more GP staking in that framework, a la General Catalyst, or, people owning parts of, Goldman owned a part of Industry Ventures before, before buying Industry Ventures,
Yeah.
So you're going to see the big firms continue to get bigger and swallow up, that segment of the market is going to just balloon in assets. As they become registered, you can do lots of things, secondaries, any kind of strategy. The fund-to-fund space is going to continue to, balloon in terms of like, the firms out there. I mean, when we started this 7 years ago, the market was pretty thin. I would say even a year or two ago, the market was pretty thin. And I just think you're going to start seeing more fund-to-funds out there of like being able to give access. So I think that space continues to grow. On the smaller end, I think, the fragmentation is still going to be there. People are going to sell their access to founders. Founders are going to take their capital because of the value that they provide. And founders still inevitably need help getting from that seed to Series A. And so, that smaller end of the market's going to, I think, continue to expand, continue to, be fragmented in terms of like the haves and the have-nots. But I feel like, there's going to be some of those firms could get absorbed. I mean, there's going to be more GP staking in that space. There's going to be, everyone's trying to get deal flow in some way, shape, or form. And so, I think in that early stage segment, you're going to see maybe I could be wrong, but you're going to see firms like swallow it up. Like, oh, why don't you come in-house to, what we're doing over here, and just become the seed team. As much as people like their independence, like I feel like you're going to see maybe more absorption of teams like that. Kind of like in AI, right? It's you're building something, and it's let's absorb you in because you can build it better here. So
Yeah. And with that landscape, just quickly, what does success look like for Summit Peak?
honestly, we want to stay in our lane and just rinse and repeat. I mean, we believe in small fund size math. If we wanna win investors' trust and partnership with putting up returns, that's TVPI and DPI. And the way to do that is staying in our lane. I mean, I think we can confidently continue to put up results, in our sweet spot of fund size. That's right now 125, 150, in that range, maybe 175. We like staying small and nimble. You know, we're a small team. I mean, I was reading about industry ventures yesterday and 45 people, although that is small for 7 billion people,
Yeah.
but I mean, 7 billion in assets.
Yeah.
But we're a small team. It means that, the thing that I love most about some of our investors is they're transparent, they're responsive, even through the fundraising process, which is a grind. The best investors are transparent, responsive. They don't ghost you. We're that way with any GP. We're transparent, we're responsive, whether it's on a co-investment. From the onset of a first conversation, I take the hard part out of the GP's work on the other side. I'll tell them, here's our process, here's what our check size is, timeline, here's how we work with our, and they're like, wow, you answered all my questions. So we try to be transparent and responsive. And so we can only do that as this small and nimble team, and so, if we grow in AUM, that means we have to add people. People management is a whole nother aspect of the fund management business. It's already, it's one thing going from an LP to a GP. Being a GP involves fundraising, involves portfolio management, running a business, and then add people management into it. And so, like, it's just another factor of, and so for us, 10 years from now, 10 years from now, I don't know, we'd be on, we're on fund 4, so maybe fund 9,
I like that.
and on kind of rinse, repeat. And so, yeah, honestly, we just want to continue doing what we're doing.
Awesome. Well, thanks so much for, sharing your wisdom, what you're, looking forward to see, and all the things that are going on in between. So thanks for joining.
Thank you, Ernest. Really appreciate you having me.
See you later, Allocator.
After Portfolio Tile, investing with a smile.